Well, it's a real pleasure to be here, and it's always very kind when David Kotek introduces you. He always says very nice things, and I really appreciate that. And I want to thank him and his colleagues at the GIC, the Global Interdependence Center, for giving me the opportunity to speak today about economic developments and monetary policy. I am very happy to be here, not just because I left single-digit temperatures in Cleveland, but because each GIC program I've attended over the years, and as David said, there have been many, I've always walked away with some new insights or perspective with which to view the economy and policy. And the GIC Central Banking Series, and this is today's event, it's a very important forum for discussing economic matters of global interest. I am privileged to say that this is actually my second talk in this series. Last March at the GIC's program with the Banque de France, I was able to give a talk there under David's invitation, which I appreciate. And I spoke about the journey from extraordinary monetary policy back to ordinary monetary policy. And today I'm going to update you on the progress that's being made on that front, and also my outlook for the economy and monetary policy. And before I go on, I should say that, as always, the views I'll present today are my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So at its January meeting, the FOMC decided to maintain the target range of the federal funds rate at 1/4 to 0.5%. And I supported this decision because I believe that policy for the time being is well calibrated for the economic outlook and the risks around that outlook. The current target range had been set in December when the FOMC implemented its first change in the policy rate in 7 years, and the first rate increase in 9.5 years. I supported that decision as well. December's increase in the rate from essentially zero recognized the considerable progress that the economy has made since the Great Recession, which officially ended more than 6 years ago, as well as the FOMC's outlook that the economy will improve further, supported by monetary policy that continues to be quite accommodative. The rate increase in December was a step on the path towards more normal policy, a journey that arguably began in October 2014 when the FOMC ended its third large-scale asset purchase program, also known as quantitative easing, or QE3. Now, the committee has indicated that in setting policy, it assesses both realized and expected progress towards the FOMC's statutory objectives of maximum employment and price stability. The policy decisions in December and in January represented the outcomes of such an assessment. And it encompasses a wide range of economic information: the official economic statistical releases and financial market indicators, as well as other information that I and other FOMC participants garner by speaking with contacts in our regions. So when the FOMC says its decisions are data dependent, which is a phrase I'm sure you've all heard, I view this as shorthand for this more comprehensive process of parsing economic and financial information to evaluate current economic conditions, and then determining what that information tells us about the median-run economic outlook and the risks around that outlook. It's important to know that the median run is the relevant time for monetary policy because it takes time for monetary policy to have an effect throughout the economy. I don't view this data-dependent approach to policymaking as something new. Instead, I view it as a step on the journey back from extraordinary monetary policy making to more ordinary monetary policy making. You'll recall that one of the policy tools the FOMC used during the recession and early part of the recovery was explicit forward guidance. It began as qualitative guidance offered in December 2008 when the FOMC indicated that weak economic conditions were likely to warrant exceptionally low levels of the Fed funds rate for, quote, some time, end quote. This changed to calendar date guidance in August 2011 when the FOMC said that it anticipated an exceptionally low Fed funds rate at least through mid-2013. Guidance based on economic thresholds was offered in December 2012, when the committee said that it anticipated that the 0 to 0.25% target range for the funds rate would be appropriate at least as long as the unemployment rate remained above 6.5%. Inflation between 1 and 2 years ahead was projected to be no more than 0.5 percentage point above the committee's 2% longer run goal. And longer term inflation expectations continued to be well anchored. A year later, in December 2013, the FOMC blended the state contingent forward guidance with an element of calendar date forward guidance indicating the information it would consider in determining how long to maintain highly accommodative monetary policy, as well as an assessment that it would likely be well past the time that the unemployment rate declines below 6.5%, especially if projected inflation continues to run below the committee's 2% longer run goal. In March 2014, the FOMC abandoned quantitative thresholds and moved toward the type of forward guidance we have today, which links the path of policy through the committee's assessment of progress, both realized and expected, towards its dual mandate objectives. The guidance continued to provide a time element by indicating it was likely that liftoff from zero would not occur for a considerable time after the asset purchase program ends. Of course, once that purchase program ended, using it as a benchmark for guidance became less salient. And in January 2015, the FOMC replaced this benchmark with simply said it judged it could be patient in beginning to normalize policy. In March of last year, the FOMC fine-tuned this by stating the two criteria it would use to assess when it would be appropriate to make the first Fed funds rate increase. These criteria were further improvement in the labor market and reasonable confidence that inflation would move back to its 2% objective over the medium term. Now, since December's liftoff, the committee has continued to indicate that the path of policy will depend on progress towards our goals, and that while the actual path that policy will take depends on the economic outlook as informed by incoming data, the committee's current assessment is that economic conditions will evolve in a manner that will warrant only gradual increases in the Fed funds rate. This evolution in the FOMC's forward guidance represents a return to more normal times. While explicit forward guidance was used as a policy tool during the recession and early part of the recovery, in more normal times away from the zero lower bound, I believe forward guidance should be viewed more as a communications device. But this step back from explicit guidance poses a challenge for the FOMC for at least two reasons. First, market participants tend to like more explicit statements and less uncertainty. Yet it's appropriate for monetary policy to respond to economic developments, whether foreseen or not. Second, while before the Great Recession, the public had a pretty good sense of how monetary policy would respond to economic developments, there's likely less clarity about the Fed's so-called reaction function now. After the great inflation of the 70s, the FOMC became more predictable and systematic in how it reacted to changes in economic activity and inflation. As a result, explicit forward guidance was rarely used. But the Great Recession required the Fed to behave in a way quite distinct from its past behavior. And consequently, there's less understanding about how policymakers are likely to react to incoming economic information than there was earlier. Thus, in my view, an important goal of FOMC communications is to explain the rationale of our decisions to the public so they'll have a sense of how policy is likely to change in response not only to expected changes in economic conditions, but also to unforeseen changes in conditions. I believe the FOMC statements have been evolving along these lines, although there are likely further steps we could take to provide more information about the conditions we systematically assess in calibrating the stance of policy to the economy's progress, both anticipated and actual, toward our dual mandate goals. In addition to the policy statement, I believe the FOMC's Summary of Economic Projections, or SEP, can be helpful in illuminating the FOMC's reaction function. Now, FOMC policymakers provide funds rate projections in the SEP that represent their views of appropriate policy, the renowned, or maybe I should say infamous, dot plot, as well as the projections of economic growth, the unemployment rate, and inflation that are conditioned on their policy path. It's important to note that the policy paths in the SEP are not policy forecasts, unlike interest rate projections and private sector forecasts. Nonetheless, because there's uncertainty around the outlook, there is also uncertainty around the FOMC's policy path. If the economy's evolution turns out to be different from what we currently anticipate, our policy path may well have to deviate from our current expectation. The policy paths in the SEP should be expected to change over time as the outlook changes. I don't view this as problematic. We want policy to respond appropriately to changes in the outlook. Thus, the actual path normalization takes could very well turn out to be either less gradual or more gradual than what we anticipate it to be today. The last SEP projections were released in December. The next set of projections will be released at our March FOMC meeting. The evolution of the dot plot in the SEP over meetings to come will provide the public with information on how participants think monetary policy should appropriately respond to changes in the outlook that reflect economic developments. So I think the SEP will be particularly helpful in March, given the global economic and financial developments we've seen since our last set of projections. The FOMC's policy statement in January made it clear that the committee is closely monitoring these developments and is assessing their implications for the labor market and inflation and for the balance of risks to the outlook. I certainly will use the time between now and the March meeting to continue to gather information from contacts in the 4th Federal Reserve District about economic developments affecting businesses, customers, and households, to look at the details of the official economic statistical releases and financial market indicators, and to consider the results from the economic models and forecasts developed by the Cleveland Fed staff as well as those of other economists. So I'll walk into the March FOMC meeting with my own assessment of the median run outlook for the U.S. economy and risks around the outlook. But I will want to hear the views of others around the table who may or may not share my views based on their own analysis. By design, the discussions at FOMC meetings contain a mosaic of economic information and analysis from all parts of the country. This regional information, along with national data and analysis, plays an important role in setting national monetary policy. The economic developments we've seen since the beginning of the year will be part of the discussion. So let's turn to those now. According to the first estimate, real GDP growth slowed considerably in the fourth quarter of last year to an annualized growth rate of only 0.7%, down from an average pace of about 3% in the second and third quarters of last year. A decline in net exports and a reduced pace of inventory investment were the main drags on growth last quarter, but non-residential investment also declined. In contrast, consumer spending and residential investment held up well. So one question is whether the softness seen last quarter will persist. Another question is whether the recent financial market volatility and a decline in oil prices are signaling a material change in the median run outlook. The declines in global equity markets since the beginning of the year partly reflect market participants' reassessment of the outlook for growth in China and their views on whether policy actions undertaken by Chinese policymakers will be effective in fostering growth there. China is undergoing a longer-run structural transition from an economy driven by trade to one more dependent on domestic consumption growth. And these kinds of structural changes can be challenging and long-lasting. Over the past couple of decades, we've seen some of those challenges play out on a much smaller scale at the regional level in the U.S. as industrial states have transitioned from manufacturing-based economies to more diversified economies. As it relates to U.S. growth, the direct trade ties between the U.S. economy and China are not very strong. Exports to China represent only 7 to 8% of total U.S. exports, and total U.S. exports are about 12 to 13% of U.S. GDP. So the direct effect of trade with China on U.S. output is small. Of course, some U.S. industries and regions of the country are more exposed to international developments via trade than others. And because many emerging economies are considerably more dependent on trade with China, the implications of developments in China for the global economy need to be considered. In addition to the decline in stock prices, we've seen another sharp decline in oil prices since the beginning of the year. In part, this reflects the same reassessment of global growth prospects affecting the stock market. But supply-side factors are also very important. Worldwide, oil inventories remain high, and oil production has not been as responsive as one might have thought, given the declines in oil prices seen over the past 18 months. This means that oil prices are likely to remain lower for longer than previously anticipated, as it's taking longer for supply to rebalance with demand. At this point, I see the market volatility and sharp drop in oil prices as posing risks to the forecast, but I believe it's premature to conclude they necessitate a material change in my modal economic outlook. While there is a possibility that a steeper, more persistent drop in equity markets could lead to a broader and more persistent pullback in risk-taking and credit extension with spillovers to the broader economy, so far we've not seen this. Solid labor market indicators, including strong payroll growth and healthy growth in real disposable income, suggest that underlying U.S. economic fundamentals remain sound. I continue to monitor developments, but until I see further evidence to the contrary, my current expectation is that the U.S. economy will work through this episode of market turbulence and the soft patch of economic data to regain its footing for moderate growth, even as the energy and manufacturing sectors remain challenged. Consistent with this view, January's advanced retail sales report suggests that consumer spending, which makes up about 2/3 of output, started the year on a strong note, rebounding from a somewhat softer reading in December. Sales gains were broad-based, including those of motor vehicles, which have been particularly strong over the past year. The relative strength in the consumer sector shouldn't be too much of a surprise because it's based on sound economic fundamentals. Consumer spending has been buoyed by continued improvement in household balance sheets, growth in personal income, which reflects progress in the labor market, and lower oil prices. Amidst highly volatile markets, stock prices were little changed on net in 2015 and are down since the start of the year. But the cumulative increase in stock prices since the financial crisis ended is still significant. Similarly, house prices have been rising 5 to 6% over the past couple of years, allowing households to rebuild their housing equity. Housing has been slowly recovering for some time. Housing starts remain below the levels consistent with projections of household formation over the longer run. Mortgage rates are low, but households are being careful and not taking on more mortgage debt than they can handle. And banks are lending to those with good credit quality. These factors are supportive of housing continuing to make a positive contribution to growth and of households continuing to build their housing equity. In the aggregate, households lost $13 trillion in net worth during the Great Recession. But the deleveraging that households undertook, coupled with the cumulative increase in stock and house prices over the expansion, means that households have recovered that loss and have added an additional nearly $18 trillion in net worth to their balance sheets. Bank balance sheets have also improved considerably, and lending, which supports economic growth, is rising. The proportion of loans that are non-performing, delinquency rates, and default rates have all been declining, and outside of the real estate portfolio are back to pre-crisis levels. At the same time, capital ratios and loan loss reserves are rising, so banks generally are in a considerably better position to handle future losses should they arise. Although risk premia have increased, especially on high-yield bonds, credit for higher quality borrowers remains available to support growth. The fact that consumer lending is rising is an indication that in general consumers are feeling pretty positive about their earning prospects. This is a very reasonable view, reflecting the cumulative progress that's been made in the labor market. So I think it's good to remember how far we've come. Over the past 6 years, the unemployment rate has been more than half, falling from a high of 10% in October 2009 to 4.9% in January. Other measures of underutilization of labor have also improved significantly over the past few years, although they're not quite back to pre-recession levels. These measures include the long-term unemployment rate, as well as the unemployment rate that includes discouraged workers and part-time workers who would rather work full-time. Non-farm payrolls are now more than 4.75 million above their previous peak before the Great Recession. Last year, the economy added 2.75 million jobs, an average pace of nearly 230,000 per month. Solid labor market performance continued into this year. Firms added 151,000 jobs in January. Now, while this was somewhat fewer than the average monthly increase last year, it's considerably more than the 75,000 to 120,000 jobs per month that economists currently estimate would be enough to keep the unemployment rate constant. I continue to expect that growth this year will be sufficient to generate some further improvement in labor markets. I wouldn't be surprised if the pace of job gains slowed somewhat based on demographics and the stage of the business cycle, but the gains should be enough to put additional downward pressure on the unemployment rate and support broader acceleration in wages. Now, I don't want to underplay the significant longer-run challenges the country faces in the labor market. Unemployment rates among minorities have been chronically higher than those of whites. The structural transition of our economy from one based on traditional manufacturing to one encompassing high-tech manufacturing and services has also created demand for different skill sets, thereby requiring workers to increase their human capital. The difference in wages between those with a college degree and those without, the so-called skill premium, has widened substantially over time, more than doubling since the 1970s. This skill premium is inducing people to increase their skills, often taking on student debt to do so. Enrollments in college are near historic highs, but non-completion rates are also quite high. So while the proportion of 25-year-olds with college degrees has moved up from 25 to 30% over the past 15 years, by this metric, the U.S. is now ranked only 12th among developed nations. These developments pose difficult challenges. As a country, we need to ensure that people can enter and remain productive members of the modern labor force, to raise our standards of living, and to make us more competitive in the global economy. The question is how to do that. I do not believe monetary policy would be effective in addressing these longer-run problems, and leaning on it to try to do so can be counterproductive. It takes the focus off of programs and policies that are better suited to addressing these issues. From the standpoint of what monetary policy can do, in my view, the totality of evidence suggests that the economy is at or very nearly at the Fed's mandated monetary policy goal of maximum employment. However, I do believe there's a role for government policy and that it should be brought to bear on these challenges. There's evidence of positive externalities from education. Less educated workers appear to benefit in the form of higher wages from working in areas populated with more educated workers. And cities with more highly educated populations experience lower unemployment rates, higher productivity growth, and higher growth in entrepreneurship than what would have been predicted by considering only the education levels of individuals. The positive externalities suggest we're underinvesting in education from society's viewpoint, and that appropriately constructed government policies and programs can be a valuable investment for the country to undertake. Now, in addition to improved balance sheets and earning prospects, lower oil prices are a third factor that will continue to support consumer spending in the U.S., even as it continues to weigh heavily on the U.S. energy and manufacturing sectors. The drop in gasoline prices from $3.36 per gallon in 2014 to $2.42 per gallon in 2015 saved the average household about $700. The U.S. Energy Information Administration forecasts that gasoline prices will average $1.98 per gallon this year. which would mean another $300 in cost savings for the average household. Now, households may be choosing to spend some of this gain. We've seen this already in high sales of SUVs and other larger vehicles. Or they may be choosing to save some of this gain. We've seen the savings rate rise. But these savings will help support future consumption. Of course, there is a downside to lower oil energy prices too for both growth and inflation. The drop in oil and other commodity prices has weighed heavily on firms in the drilling and mining sector and on their suppliers. And these firms have responded by cutting jobs and reducing investment. Some firms may face bankruptcy and will need to merge. I expect firms in these sectors to face continued pressure. Manufacturers and other firms exposed to U.S. trade have also had to operate in a very challenging environment. The dollar has appreciated more than 20% since mid-2014, reflecting the expectation that real growth in the U.S. will continue to be stronger than growth abroad, as well as projected interest rate differentials between the U.S. and foreign economies. A stronger dollar means better terms of trade for U.S. consumers and businesses, which is a positive for a growing economy in the longer run. But in the near term, the appreciation has been a considerable drag on U.S. export growth. Should economic growth in our trading partners weaken, this would put further strains on U.S. exports. So I expect net exports will be a negative influence on real GDP growth for some time to come. The latest round of oil price declines means headline inflation will remain lower for longer than I previously thought. Inflation has been running below the Fed's 2% goal for quite some time. Headline inflation, measured by the year-over-year change in the price index for personal consumption expenditures, was 0.6% in December, and core inflation, which excludes food and energy prices, which tend to be more volatile, was 1.4%. Though inflation partly reflects the effects of declines in oil prices and other commodity prices since mid-2014, as well as the appreciation of the dollar, which has held down the prices of non-petroleum imports into the U.S. While headline inflation is likely to remain low in the near term, I still think a reasonable forecast is that inflation will gradually return to 2% over the median run. I can point to a couple of things to support this view. First, measures of underlying inflation like core, trim mean, and the Cleveland Fed's median CPI are higher than headline inflation. And they've remained relatively stable despite continuing sharp drops in the prices of oil and other commodities and the appreciation of the dollar we've seen over the past 18 months. In my view, longer run inflation expectations, an important factor in the inflation forecast, have also been relatively stable even in the face of sizable declines in energy prices, which according to analysis by the Cleveland Fed staff account for much of the movement in longer run inflation expectations. I take less of a signal from the downward moves in market-based measures of inflation compensation because estimates likely suggest that these more likely reflect changes in liquidity premia and in inflation risk premia rather than in inflation expectations. Oil prices cannot continue to decline indefinitely, nor can the dollar continue to appreciate forever. At some point, both will regain some stability and the effect of previous changes on inflation will dissipate. In fact, we saw those dynamics play out toward the end of last year when oil prices and the value of the dollar had begun to stabilize and the underlying inflation measures began to firm. When oil prices and the dollar both regain some stability and with inflation expectations remaining stable and economic growth continuing, it's reasonable to expect that inflation will move back slowly to 2%. It just might take a bit longer now given the most recent decline in oil prices. Of course, going forward, it will be important to continue to monitor inflation developments, in particular inflation expectations, as well as economic developments both here and abroad. We want to set the path of policy based on an outlook informed by economic developments, a path that will best achieve our longer-run goals of maximum employment and price stability. Given my outlook that the economy will work through this rough patch and resume a trajectory of moderate growth with continued improvement in labor markets and a gradual return of inflation to 2%, I believe the appropriate policy path will involve gradual reductions in the extraordinary level of accommodation that was necessary to address the Great Recession. Even as policy gradually normalizes, it will likely need to remain accommodative for some time to come, given some of the forces still impacting the economy. For example, slow growth abroad, dollar appreciation, more restrictive financial conditions, and the continued rebalancing of supply and demand in the energy sector. The actual path the Fed funds rate will follow will depend on economic developments and how they affect the outlook. As we've seen, things can take unexpected turns. Our economic forecasting models are, by necessity, simplifications. The economy is dynamic and can be hit by various shocks that might lead to changes in the medium-run outlook for employment and for inflation, to which policy would want to respond in a systematic fashion in order to promote maximum employment and price stability. It's good to remember that confidence bands around economic forecasts tend to be wide. I wish we were able to forecast with more precision. Economists are working on it. But unfortunately, the state of the science, or perhaps I should say the state of the art, isn't there yet. For example, averaging across several models, the 70% confidence interval around a forecast of CPI inflation 1 year out is about plus or minus 1 percentage point. The confidence band around a forecast of short-term interest rates 1 year out is of similar magnitude. When the FOMC releases its projections, some observers tend to focus on the dispersion across FOMC participants. But this dispersion is actually pretty modest compared to the uncertainty around the projections. But just because we cannot forecast the future with as much precision as we'd like does not mean the exercise is without value. The discipline of forecasting how the economy might evolve over the median run and assessing the uncertainty around the forecast is an essential part of the framework for setting monetary policy. It provides a useful methodology to help policymakers avoid focusing too much on short-run changes in the economic data or volatility in the markets. It forces one to consider how those changes in economic and financial data may or may not change the medium-run outlook, the risks around the outlook, and the appropriate policy path. It's the construct through which our policy making can be made systematic, yet responsive to changes in economic conditions. The outcome of this process is communicated in our Summary of Economic Projections, SEP, which is why I view the SEP as an important part of FOMC communications, one that will continue to serve us well as we continue on the journey towards more normal monetary policy. Thank you very much for your attention. And as David said, we have time for questions, so I'm happy to take some.
Who's got the first question?
So I just have a question on, could you comment on the national debt and whether or not you see that as a threat to our economy, either in the short or long run?
Well, in the short run, actually, it's come down in terms of our deficit spending. So it's on right now. It's on a sustainable path. But when you get out the medium and longer run, it's not. And so that's something that another one of these longer run challenges that I think the country is going to have to deal with.
Let me get George.
Where did the 2% inflation goal come from?
Well, this has been discussed over many, many years, right? The fruition of this was the establishment of the explicit goal, but many FOMCs before the current one have talked about becoming an actual numerical goal for inflation. And there was lots of discussions about what measure we should use. Should it be the CPI? Should it be the PCE, which is currently what the Fed is using and what our target is? There were discussions about what the right level is in terms of price stability. Of course, there's measurement issues, so that argued against setting it at 0, which would be a normal person's thinking price stability means 0 increase in prices, but because of the measurement error, they needed to pick something above 0. So it was basically and then looking at other countries who had moved into an inflation targeting regime. And so sort of balancing all the costs and benefits and which is the appropriate measure, a 2% seemed to be about right. And it was consistent. If you remember before we actually had the explicit target, Alan Greenspan had this definition of what inflation rate would basically mean that you wouldn't be worrying about it when you're actually doing economic decision making. Could you ignore prices? You wouldn't have to worry about it. And so it was basically balancing those things, and we hit on 2%.
Thank you for being here and your comments today. I'm curious about the size of the Federal Reserve's balance sheet. The bond purchase program ended several months ago. Through normal amortization, might expect it might have declined to some degree, but it seems to be stickily about the same level. Does the Federal Reserve have some thoughts about what the target should be when the balance sheet will decline and how that's going to impact things going forward?
Right. So you're exactly right. The balance sheet has been staying stable because we've been reinvesting or MBS and treasuries as they roll off. So we've been maintaining the size of the balance sheet. And you probably know that the Fed has put out exit strategy principles or normalization principles about the balance sheet. So at the moment, right, we're reinvesting and maintaining the $4.5 trillion size of the balance sheet. But we showed in December that despite the very large balance sheet, we're able to bring up short-term interest rates. Okay, what we've said is that eventually, right, we will first, in handling the balance sheet, we're going to stop reinvestments, right, and then that'll allow the balance sheet to shrink slowly, and that basically we just want to maintain that balance sheet to slowly shrinking. In July, the Fed announced through one of Janet's press conferences that there's a undergoing project to actually determine sort of what framework monetary policy will be after we get more normal policy, and that will ultimately determine the size of the balance sheet. But in that, no matter what we end up doing there, right, it's going to be a considerably smaller balance sheet than we have today. It probably may not go back to the size that we had before the crisis, because now we have this other tool, which is paying interest on excess reserves. But nonetheless, it'll be a much smaller balance sheet. But right now, the idea is to let that be passive and run monetary policy as we did before via short-term interest rates and communicate that via short-term interest rates. My own particular view is I'd like to see a few more increases in the funds rate, right, before we stop reinvestment, and then we can stop reinvestment. Because the same criteria that we'd use for a funds rate increase is, to my mind, the same criteria we want to use for when we want to stop reinvestment and start that process.
Could you elaborate further on your personal opinion on the negative interest rates, such as in Japan and Europe right now, and whether that option should be on the table as likelihood it could occur?
Yeah. So my own view is that policy is going to be moving gradually higher, not going backwards. In terms of, I think my own personal view is I'd kind of like to stay away from negative interest rates because I think there's plumbing in the U.S. financial markets, complicated plumbing and different impacts between mutual funds and banks. So I'm not really a fan of negative interest rates. That said, it does seem to be having a beneficial effect in some of the other countries, as you mentioned. So I don't want to criticize what they're doing. I just would be I would want to study it much more before we go that way. But despite all that, my view is that the economy, we're going to be moving rates up, not going backward.
As a follow-up to that, given the length of the current expansion and the level of interest rates that we have today and the increasing appearance of negative interest rates abroad, what is the likelihood, in the event that the next recession starts sooner than your consensus forecast, maybe originating from abroad, what is the likelihood that we may see negative interest rates in the next downturn?
Well, again, this is a question of if things turn bad, so that the modal forecast doesn't come to fruition, we're hit by a negative shock, what tools would the Fed want to use to address that? right? So we still have our balance sheet as one of the tools, right? We could buy assets again if we wanted to. We could, think about negative interest rates. As I said, I think we'd have to study that a lot more. But that would be a tool. And then the third one is some of the things I talked about in the speech today, which is forward guidance, right? Giving people an idea that, we'd be more accommodative for longer than they might currently anticipate. So there are tools on the table for a central bank to use. Right? But again, my modal forecast is that we're not going to need to do that.
You mentioned robust house price increases. I'd add that the rate of increase for entry-level homes has been much higher, and that's been offset with increasing home buyer leverage. Given that home prices are expected to continue increasing faster than fundamentals, are you concerned at all that we're setting ourselves up for a disconnect between home prices and market and basic fundamentals like wages and inflation?
So I suggest not, because I think what we've seen is a slow, right, recovery in housing. I don't think we're at bubble levels. I don't think that we need to be concerned about that. I mean, there is some, and I also think that households are being very measured in the way they think about taking on debt. So I don't think we're getting out of control. If anything, some economists had predicted that housing would have been stronger by now. But I think it's this, recognition that consumers now and households really realize, right, the dangers of taking on too much debt. So my view is continued moderate increases in housing, not too worried about it getting out of hand. I think banks have been pretty restrictive in some sense in extending that kind of credit.
Banks aren't the lending.
Well, no, I agree, but we have to look broader. But I think financial markets in general, I don't see, I don't think it's bubbly.
Two questions. One is, what does the term medium range mean in terms of years? And the second question is, how much consideration is the FOMC giving to our interest rate increases and the dollar, and in turn that impact on our economy?
Right. So you're right. We've never really defined necessarily what median run is, and I would suggest that median run may vary with where you are in the business cycle. But if you look at the SEPs, and again, I'll point you to March, there'll be a new set, but I'll use the December ones, right? And you look at the path of the funds rate in there and the other economic projections, what you'll see is that by 2018, so 3 years out, or 2 years out now, right, the funds rate is just approaching where most economists on the FOMC think that longer run interest rates will be. So it's a 2 to 3 year time range given that December SEP. And I think that's probably the best way to sort of think about what the variation across participants, but also what the median forecast looks like. I still think the SEP is a really good tool for sort of conveying what the median person on the FOMC is seeing in the economy. And I'd point you to that in March to sort of get a handle on the current thinking.
Hi, can you remark on the effect on short-term interest rates for the U.S. relative with the increasing use of negative rates abroad?
Well, this is again, right, what are interest rate differentials, and that's feeding into sort of the appreciation of the dollar that we see, right? And so there is this sort of, right, the U.S. economy is doing relatively much better than some of the economies abroad, but even Europe is doing a little better, right, and expected to do better this year. So again, right, that's sort of one of the financial conditions that's, holding back net exports in the U.S., dollar appreciation. But again, when the dollar starts to stabilize, right, I'm not saying that it's going to necessarily depreciate, but not appreciate at the same rate, right, we would expect that those effects on inflation would feed through, dissipate.
Last question?
I'll take the last one. Are there any other?
Two quick ones, Loretta. First of all, do you like Sarasota?
I love Sarasota.
Bravo. In the last 48 hours or so, there is this discussion which started with removing the $100 bill and the $50 bill. We saw the Eurozone eliminate the 500 euro bill. Larry Summers is now out calling for this question. The Federal Reserve prints those bills. I don't know if you've had any discussion or any comment you would want to make on the changing currency.
I
This
think
is
the
not
Bureau.
monetary policy.
All right, the Bureau of Engraving prints those bills, I'm pretty sure. So I'm going to take a step back and say, you know, I have no comment on the $100 bill.
I have one I can give to you.
See, I haven't seen one in years, so
Ladies and gentlemen, Loretta Mester.